Well, hello, and welcome back. Sorry for the delay in releasing new videos, but I hope this one you will like today. It's a trading without watching the market. Is the myth or method? And stick around at the end of it, or closer to the end of the video, I will actually create a system, aka strategy, so that you will know what I'm talking about. And I just want to make a quick disclaimer that, as always, whatever I'm saying here, I'm not a financial advisor. I'm not advocating for you to trade the way that I trade. This is just I do the way. So do your own due diligence and make sure that you understand what you're doing. Now, here's the simple answer. Is it a myth or a method? In my opinion, it is a method. It's not a myth. I can debunk that myth if you think that it's a myth. But discretionary traders, and I've talked to quite a lot of them, they will say, well, you know what, they disagree. They will say, no, it is a myth. You can never make money if it's just mechanical systematic trading. It's got to be based on your experience. So in their world, they think that it's kind of do it all blindly, that you need to take more inputs in. In my opinion, the less you need to take the inputs, the better you are, but that's what I will discuss as well. That's why the systematic traders, most of them at least, will agree that yes, as long as it's some kind of a rule and it can be executed, you can automate it. Basically, you can become a machine. So at the end of this, again, not at the end of it, but closer to the middle of this video, I will actually start creating the system, the strategies, so you will understand what I'm talking about to be more precise. But before I dive into this, let me just give some explanation to people who don't know what mechanical trading is. So what mechanical trading is, it's the trading based on systematic rules, rule-based trading. And the rules, they got to be rigid. So you can't be just relaxed and say, you know what, today I will do it this way and tomorrow I will do it a different way. No, the rules are rules. So you have the rules and you continue doing it based on these rules. The rules can be technical or can be fundamental or can be both. As long as the rules are rigid, meaning that you follow it to the T, you don't make mistakes. The mistake is that you don't follow the rules. That's what the people will be then the mistake. It's not that you lost in the trade. It's when you made a mistake by not following the rules. So you cannot deviate from it. That is why you would call that type of the trading is mechanical trading. Okay, kind of like you were a robot, basically, right? So now, how do you do that then? Well, step one, you need to define what rules to use. It's more known to be called strategy or system. I call it system, so I will keep referring to it as a system. It's easier for me that way because that's what we teach in our program as well. And I've been doing it for years now, so that I could just keep calling it system. But keep in mind, strategy and system is pretty much the same thing interchangeably. So whatever you see on the internet when people refer to strategies, that's what they call strategies. I call them systems. It's the same thing. You need to backtest all the strategies, because if you don't backtest, you're kind of literally doing it all blindly. Because some things you think that they are logical, but once you start implementing them, they're becoming really not logical, and the system is just may not be a good system. So you can't just pick random rules. You need to pick rules that at least make sense. And that is why when you're testing things out, there are all kinds of pitfalls. So you need to be aware of. So like over optimization or wishful thinking or not enough testing. So there's some tricks that you need to be aware of. But I don't want to dive into this right now. Okay. Now, what does it mean? The step two, once you've picked the rules, once you know the system, you really need to know it inside and out. What it's capable of, what the hidden dangers are. Because let's say you're testing from a specific period of time and everything looks peachy and great, but in reality, if you widen your testing period, all of a sudden it's not as good. Some people do it as called in-sample testing and out-of-sample testing. A fancy way of saying it, cannot test it with the known data and cannot test it with unknown data. And in this case, that's why I would test it as far as possible, so you would know under all kinds of different market conditions how your system behaves, right? So you don't want to test only like 10 trades and say declare it it's a good system. You need to really test it out much more. That's why the discretionary traders sometimes they test like maybe, if they're lucky, 100 trades, but it's because it's much harder for them to test things out based on the discretion, because again, their rules are kind of more relaxed, so it's harder to test. That's why I like mechanical trading, systematic trading, because I can program in the rules and just test them all out, right? And especially when you test things out, you need to know what your drawdowns are. Basically, when you're losing money, because it's not how much money you're going to make. Everyone is happy when they're making money. They will be really unhappy when they're losing money. Okay, that's another important point to make. Now, step 3. Well, because it's a mechanical system, you need to automate it. But how do you automate it? Well, either you write the program or you use some program to actually automate it, or you have a drone, a person, or you become your own drone where you just enter the orders religiously so that you don't deviate, you don't overwrite, you don't overwrite the rules, you don't interject your discretion into it. Hence, it's not discretionary trading, it's mechanical trading. And that is why it's all about the automation. As I said, it doesn't have to be through the program. It can be done with the person involved, but it has to be automated as far as the execution is concerned. Now, the 4th point is, well, you really need to be kind of obsessed with this, but don't be obsessed to the point where you monitor everything for every single tick, for every single move. Basically, you actually need to be the opposite of watching everything too closely. You need to be watching it more from the distance, because trading is all about the what is it called? It's all about psychology in terms of that it allows you to operate in probabilities and not really concentrate too much on every single trade, because every single trade is meaningless. What makes and breaks you is what's over time is going to happen to your trading, right? So that is why it will be a lot less stress if you paying attention to a more bigger picture and kind of looking at it from the distance versus trying to look at it all the time and every single tiny movement. So, which means that psychology of the detaching from the screen, that's why it's a method. It's not the myth, as as we started the whole video. Is less screen time is less stress, because the longer you watch the screen, the more the probability, actual probability, I mean the actual thing happening for you, is for you to make some stupid mistakes. Either because of the fear of missing out, you want to jump on a hype and you see that, oh man, the Bitcoin is going up, I need to buy Bitcoin, and then it drops. Like today it dropped 4% as I'm recording this video, and yesterday it was up a lot, right? So if you missed that move, you jumped on it, and all of a sudden you were in the world of pain right now, even though it seems to be a good thing to do. But again, you need to have specific rules to jump in and jump out. Or you do another fear of losing profits. Let's say you see some profit and say, okay, I'm going to take the profit. But in reality, you take the profit too soon, because there's a fear of admitting the defeat where you have a losing trade, and you will hold on to the losing trade for as long as it's not making you even or break even, or basically makes more money for you. So it just... another crazy kind of like, you do everything in reverse. Instead of letting the winners run, you cutting them short, but letting your losers run, which is the opposite of what you need to do in trading, right? And then because you're not making money, sometimes you're sitting on your hands and you want to make something, so you want to do something, so you will find some bet setups, marginally convincing yourself that they're still good setups. I mean, they're good-ish, so let me go in. So you need to have basically be detached from the screen, because the more you're not looking at the screen, the better you are. If you did your homework, if you did your testing with the mechanical system, let it run. Let it run so you don't have to watch it and monitor, because it will make your life 10 times easier, or even 100 times easier. I mean, whichever one you pick. So how do you detach yourself from the screen? Well, as I said, find a system that can be automated, right? So find the rules, create a system, make sure that you understand it, and then it's easier if the execution of the system is done so that you're not again watching in the market hours. Because when it's in market hours, it's very hard to detach yourself from your screen. The market is always moving, there's always action, you're kind of getting glued to it, and you really don't want to do that, right? So That is why I personally do a lot of end of day trading, so where my orders are entered before the market opens up, so I don't have to do anything. I just the orders are in, I verify that my orders are in, and I'm good to go. So I don't need to do anything at that point in time. So, but obviously for that I need to have enough confidence that my system will work for me, right? And it's not just one system, usually it's the suite of systems, but I will get to it shortly. So that's why you need to know your system in and out. And as I already mentioned multiple times, just do not sit in front of your screen. Even if everything is mechanically done, just don't sit, because you will be tempted to do all kinds of stupid stuff or override things, or will be upset for no reason because all this ups and downs, it's just ups and downs. So you don't need to really watch it all the day. So that is why you don't need to check your P&L daily either. Sometimes it's better to just check maybe weekly what's going on. It's good to check your P&L just to kind of like, okay, good, or okay, bad for the day, but nothing spectacular. But just don't judge your system by each trade, because each trade is meaningless. It's the whole several chain of trades that will make the system or break the system. Now, let me create an example system. So the idea, well, since I'm a more technical oriented person in terms of for technologies and by my background, so I'm more technically oriented, and I don't like the kind of like accounting problem. So trying to decipher the fundamentals, it's not my way to go. So our software, the one that I wrote as well, the Quantum X, allows me to basically backtest using technical analysis, kind of moving averages, or RSIs, counters RSIs, or some momentum indicators, like basically different indicators which allow me to judge and create the systems. So as an example, in this case, what if we'll just do a very, very simple system where we'll try to get in if an instrument is above the 200-day moving average, simple moving average, and if it dips below, then we'll just get out. So as an example, here's the Apple. Here's Apple. And you can see this is from 2019 over here all the way to 2025 right now. So every time Apple, basically in this particular case, we'll say every time Apple is trading above 200-day moving average, we'll get in. And as soon as it closes below, we'll get out. But as soon as it's above, you can see that sometimes we can stay in this trade for quite a while. Let's say if you got in right here in 2020 in April, you would have stayed all the way up to here, probably all the way to 2022. Like for 2 years, you would have stayed in the trade and made significant returns, right? From $50 something all the way to $150, which is a significant return. It's like 3 times the return, right? So, but again, it's seemingly good return because there's whipsaws that can happen. So now, if I show you the performance of that system, which I tested from 2007 till now, so you will see what's going on. You can see that it can really outperform the market. The red line is the market. This brownish line, yellowish brownish line, is your equity, would have been your equity. So how you can turn $100,000 into almost $6 million? Well, that's how. I mean, in this particular case, you can do it with that particular very simple mechanical system, right? I don't have to sit around and watch what Apple is going to be doing. I don't have to think too much. It will just get in or get out based on these 2 rules. 200-day moving average above, we get in and we stay with the trade for as long as we're not closing below. As soon as we close below the 200-day moving average, we get out. That's it. Like 2 rules. As simple as it can get. Even these 2 rules, because of the statistics, it shows me that, oh man, this can be really good. The returns are very awesome. My win-loss ratio, meaning that for every dollar that I actually risk, I can get almost $12. So you can see that it's pretty good system. But at the same time, look at the most recent action in 2025. Well, the market is rallying, but Apple was not really rallying. Remember? Like over here, if you can look at it, Apple was below the 200-day moving average. So it took a while for the Apple to actually recover before we got back in right here, the end of in August actually in 2025. So that's why you can see there is kind of flatness in this system. So it's just because it was sitting and waiting, but that's where the mechanical portion of that system comes into play. Okay, so you have to do it this way. Now, I will show you what it is, what it looks like based on yearly returns. As I said, it can be really awesome. Sometimes it really outperforms the market. This is the market, what the S&P 500 does, and this is what the comparison is to the market. But let's say like this year, as I said, it's still not even comparable. So because of this, and here's the monthly, you can see how it was flat, 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 and now something happening in August. We finally getting back into action for this particular system. So because of this, you can't really say that, okay, let me just use Apple only, because who's to say that Apple will continue to be producing the good results, right? You need to be more agnostic to it and say, well, you know what, I need to choose other stocks to diversify my returns across multiple different streams. But how do I choose which one to get into? Okay, I mean, there is like a common, the Magnificent Seven right now, like Meta and Nvidia, Microsoft, or whatever it is, from S&P 500. Or how about I'll be more agnostic and say, how about I will do it based on the whole Nasdaq 100. I'll just take all the 100 stocks from Nasdaq 100 index, and I will get into 10 positions of those. Why 10? Because I want to be enough diversified, but not too much diversified, because otherwise all I would be doing just will be repeating the index. I might as well just work with the ETF then, QQQ, which is in this case. But let's say I want to beat the QQQ. I want to have something else happening for me, like more concentrated in more appropriate stocks. So, but which ones do I get into? Because there are so many stocks which can be a legitimate candidates where they are trading above 200-day moving average. Like, which one do I get into? I can only enter into 10 positions at any given moment, right? So which one do I enter? Well, I can use such a notion called ranking. So I can rank my candidates by a secondary means. In this case, I will say, okay, whichever ones are of all these candidates, let's say that we have out of 100 stocks, maybe let's say 60 are legitimate right now to be above 200-day moving average. Okay, so which ones do we get in? Well, the ones which generated the highest return in the last 200 trading days, those are my high ranking candidates. So those are the 10 ones that I will get in. Once I get in, I will again wait for that 200-day moving average to close, for that each stock to close below the 200-day moving average, and I will get out, right? Very simple system. So this is what will happen if I do that. Okay, the same performance, slightly less returns, but much, much larger drawdowns. Why? Because when I picked Apple, at random by the way, it just happened so with the Apple action, the way Apple operated, it was just easy, and somehow it was only 30-something% drawdowns. But when other stocks get in, they maybe become more volatile. Let's say like Nvidia can be more volatile, or Tesla is a part of it probably. I mean, I don't know, whichever one it picks based on this rule can be more volatile, right? And because of this, it can generate much bigger drawdowns. So because of this, and let me show you what I mean. So here's the returns. I mean, look at that return in 2020. You would be probably ecstatic of having that type of system in 2020. See only the 2 years which are negative years. But at the same time, the yearly drawdowns can be dreary, quite demoralizing. Like 60% drawdown is not something to breathe, right? So you still want to probably avoid this type of action, but look at it. This type of a system would generate 21% return this year already, right? And what I mean by this is if I look at monthly, then it's kicked in back in April, generated more in May, generated more in June, barely generated anything in July, but then generated already, we're halfway through August and already generated 6% return in August. And this is the simple system we're talking about, right? So how do we know what else is hidden in there? Well, the bigger drawdowns is because, remember, our rule for the exit is very simple in this case. I'm just saying, well, we need to close below the 200 moving average. Well, whatever happened to be getting in while the market is tanking already. So we got in because we're still above 200 moving average and we kept continuing to go down. And as soon as we try to recover, we get in again and then it goes down even further. So this way you keep basically buying and selling a lot later, or maybe not a lot later, but later with a loss, and buying again and selling with a loss, buying again and selling with a loss. So it's kind of like a death by 1,000 cuts. It's called a whipsaw. in this particular case for this type of strategy. It's called long-term trend following strategy, by the way. So it's just the hidden dangers is that it's possible to generate quite significant losses with this particular type of strategy. As you saw by statistics, with this approach, it can be like 60% drawdowns. I didn't run it from 1995 to like a .com bust. Maybe it was even 70% or 80% drawdowns at that time. So probably it's insane to trade it on its own like that, right? Plus, because we're talking about only 10 positions, so there is still luck involved when there is 10 positions only. So what can we do? Well, you can improve it by not allowing, let's say, to open the new positions if the overall market is in a bad condition. So in this case, I'm saying, okay, how about the index, Nasdaq 100, and S&P 500 ETF? They both have to be traded, wherever they are right now, above their own 200-day SMAs plus the 2 ATRs. Why? I'm giving some caution, so it's not just 200 SMA in this case, but I'm giving some caution to have like a blanket statement, like don't open new positions unless we're traded this in the index and the SPY both traded about this type of the indication. This way it's called market filter and market regime. Okay, it's very simple, but it is really powerful. As you can see, we can avoid the 60% drawdowns and have much smaller drawdowns in essence, right? Like here in 2008, and even 2022, again, instead of having 60-something percent drawdown, it's only 46% drawdown, but still, it's not something to really breathe in. I mean, it's not that easy to handle that type of a system, but it can provide very good returns, right? Remember, in 2022, it had before 44% drawdowns. Now it's 22 not drawdowns returns. Now it's 24% returns only in 2022. So it can still not that easy to trade that type of a system, but you can see that what would be right now. Like you would think that maybe Apple is a good candidate or Nvidia is a good candidate, but nope. This particular system would have opened WBD, I forgot what that means, MicroStrategy, right? Constellation Energy, Apollon, I forgot the name. So like basically you can see it's not the ones that you would probably, Pelletier, okay, that one that I know, like recently it's been on the roll, but you can see that that this is the Broadcom. So there are some things that you maybe are aware of, but you would probably not directly pick them because if you have affinity to, let's say, Microsoft or Apple or Nvidia right now, so apparently those are not good candidates right now. These are the good candidates. So why not to enter what is actually good and stay with it and stick with it, right? So, but can we improve this even further? I said it's insane to trade that type of system by itself. So yes, you can improve it by having more systems which are working at the same time for you. So that's how you improve it. And in this case, it's called suite of systems. So it's the suite of systems where there's non-correlation in action, where one system goes down, the other goes up, and this way they prop each other. So this way you don't have as many or as big of the drawdowns. And different systems, they work in different market conditions, right? So here's the combination of 15, I think. Yeah, 15 systems. I mean, look at the returns. 40% CAGR return, only 18% maximum drawdown. You can see the forest of drawdowns is much, much narrower, much smaller in size than before. And this is just a sample of 3 workshops that I ran. 2 last year, 1 this year. And this is a combination of these 3 workshops. I mean, you can buy actually the combination of 2 at least of them on our website and the tradingsystem.com. You can see it is Ultimate Trading Machine, I think it's called. So, but just so you're aware, there is possibility for you to have more than one system. So that is why, again, quick conclusion. Is it a myth or a method? In my opinion, as I started the whole video, it is a method, right? So less screen time, it is quite possible, and you better actually do it. It's easier for you to have that way. Simple rules are reliable and consistent in results. So that is why you need to have different systems for different market conditions, which are handling different basically conditions with their own simple rules. But when you combine them, you get the holy grail of trading, at least in my opinion, and Lawrence, my business partner. So this is what we preach, how to run together things. So to conclude it again, if you have any questions about this, write to info@tradingsystems.com, and by all means check out our website tradingsystems.com, and you can see that we also have 4 books, at least right now 4, but probably will be more soon at the end of the year. I'm writing my 2nd book as well. Lawrence already has 3 books. I have my own book on Amazon, but you can again check us out on the website, and obviously watch all the videos for this YouTube channel, and I'm sure you can get a lot more information from it. But otherwise, reach out to me, put a like, and if you have more questions, send the questions to the email, or if you really want to talk to me, book the call and go to our website. It's under the Elite Mentoring. You can book the call right then and there. There is no consequences, like a financial consequences for you to do. It's all about if you want to really find out how this approach can be applied to you. So otherwise, I hope that's helpful, and I'll see you next time. Bye.